Okay, and Andy, if you're here and you could stand up, I think the crowd would like to say thanks. We have one other special guest too. After doing an incredible job for all Berkshire shareholders, and particularly for Charlie and me, Ralph Shea retired this year, but Ralph and Lucy, I believe, are here, and Ralph and Lucy would stand up. The shareholders and I would like to say thanks. Scott Fetzer was one of the best acquisitions we ever made, but the reason it was among the very best was Ralph. And a great many of the other companies that we own now, our ownership was made possible because of the profit that Ralph delivered over the years. So thanks very much, Ralph. Now we will come to order. I will go through this fast. I'm Warren Buffett, Chairman of the Board of Directors of the company, and I welcome you to this 2001 Annual Meeting of Shareholders. I will first introduce the Berkshire Hathaway directors that are present in addition to myself. First of all, of course, is Charlie on my left. And if the directors will stand when I give your name. Howard Buffett, Susan Buffett. She was the voice on the songs, the ones that were sung well. Malcolm G. Chase, Ronald L. Olson, and Walter Scott, Jr. Also with us today are partners in the firm of Deloitte & Touche, our auditors. They are available to respond to appropriate questions you might have concerning their firm's audit of the accounts of Berkshire. Mr. Forrest Crutter, Secretary of Berkshire, and he will make a written record of the proceedings. Ms. Becky Amick has been appointed Inspector of Elections at this meeting. She will certify to the count of votes cast in the election for directors. The named proxy holders for this meeting are Walter Scott, Jr. and Mark D. Hamburg. We will conduct the business of the meeting and then adjourn the formal meeting. After that, we will entertain questions that you might have. Does the Secretary have a report of the number of Berkshire shares outstanding entitled to vote and represented at the meeting?
Yes, I do. As indicated in the proxy statement that accompanied the notice of this meeting that was sent by first-class mail to all shareholders of record on March 2, 2001, being the record date for this meeting, there were 1,343,041 shares of Class A Berkshire Hathaway common stock outstanding, with each share entitled to one vote on motions considered at the meeting, and 5,505,791 shares of Class B Berkshire Hathaway common stock outstanding, with each share entitled to 1/200th of one vote on motions considered at the meeting. Of that number, 1,116,384 Class A shares and 4,507,896 Class B shares are represented at this meeting by proxies returned through Thursday evening, April 26.
Thank you. That number represents a quorum, and we will therefore directly proceed with the meeting. First order of business will be a reading of the minutes of the last meeting of shareholders. I recognize Mr. Walter Scott, Jr., who will place a motion before the meeting.
I move that the reading of the minutes of the last meeting of shareholders be dispensed with.
Do I hear a second? The motion has been moved and seconded. Are there any comments or questions? We will vote on this motion by voice vote. All those in favor say aye. Opposed say by I'm leaving. The motion is carried. The first item of business of this meeting is to elect directors. If a shareholder is present who wishes to withdraw a proxy previously sent in and vote in person on the election of directors, he or she may do so. Also, if any shareholder that is present has not turned in a proxy and desires a ballot in order to vote in person, you may do so. If you wish to do this, please identify yourself to meeting officials in the aisles who will furnish a ballot to you. With those persons desiring ballots, please identify themselves so that we may distribute them. I now recognize Mr. Walter Scott, Jr. to place a motion before the meeting with respect to election of directors.
I move that Warren E. Buffett, Susan T. Buffett, Howard G. Buffett, Malcolm G. Chase, Charles T. Munger, Ronald L. Olson, and Walter Scott, Jr. be elected as directors.
It has been moved and seconded that Warren E. Buffett, Susan T. Buffett, Howard G. Buffett, Malcolm G. Chase, Charles T. Munger, Ronald L. Olson, and Walter Scott, Jr. be elected as directors. Are there any other nominations? Is there any discussion? The nominations are ready to be acted upon. If there are any shareholders on the election of directors, and allow the ballots to be delivered to the Inspector of Election. Would the proxy holders please also submit the Inspector of Elections a ballot on the election of directors, voting the proxies in accordance with the instructions they have received. Ms. Amick, when you are ready, you may give your report.
My report is ready. The ballot of the proxy holders in response to the proxies that were received through last Thursday evening cast not less than 1,126,480 votes for each nominee. That number far exceeds a majority of the number of the total votes related to all Class A and Class B shares outstanding. The certification required by Delaware law of the precise count of the votes, including the additional votes to be cast by the proxy holders in response to proxies delivered at this meeting, as well as those cast in person at this meeting, if any, will be given to the Secretary to be placed with the minutes of this meeting.
Thank you, Ms. Amick. Warren E. Buffett, Susan T. Buffett, Howard G. Buffett, Malcolm G. Chase, Charles T. Munger, Ronald L. Olson, and Walter Scott, Jr. have been elected as directors. The next item of business was scheduled to be a proposal put forth by Berkshire shareholder Bartlett Naylor. On April 20th, 2001, Mr. Naylor advised us he was withdrawing his proposal. Accordingly, we will not have the proposal presented at this meeting. After the adjournment of the business meeting, I will respond to questions you may have that relate to the business of Berkshire, but do not call for any action at this meeting. Does anyone have any further business to come before this meeting before we adjourn? If not, I recognize Mr. Walter Scott, Jr. to place a motion before the meeting.
I move this meeting be adjourned.
Motion to adjourn has been made and seconded. We will vote by voice. Is there any discussion? If not, all in favor say aye. All opposed say no. The meeting is adjourned. I ask you, am I getting slower in my old age? No. Now, the first, we're going to go, we have eight microphones strategically placed. We have the first two on my right, far back, 3 and 4, and over to this back area over here, and then up front for the 7 and 8. And if you have a question, just go to the microphone and queue up at the microphone, and we'll keep rotating, like I say, until noon. Then we'll have a break, and then we'll start again around 12:30 or thereabouts and go until 3:30. Now, first question in area 1, we have a special guest. I received a letter from Mark Perkins on April 5th telling me about his daughter, who has been a shareholder since she was 6 months old, and she's going to be 4 in November, and she would like Marietta would like to ask the first question, and frankly, I take all the questions from 4-year-olds, and Charlie handles them from anybody that's been around a little longer. So, Marietta, if you've got the microphone there, would you ask your question, please?
I'm 3. Her question was, she said she was 3, and she says, Berkshire Hathaway, fistful of dollars, and she says, what should we invest in now so that she'll be ready when she goes to college?
What should she invest in, or what should Berkshire invest in?
And what should Berkshire invest in?
Well, Berkshire would like very much to buy businesses of the same quality and with managements of the same quality and at prices consistent with the 8 businesses that we bought over the last 16 or 18 months. Our first preference is and has been for many decades, although I would say most observers didn't seem to realize it, but our first preference has always been to be buying outstanding operating businesses, and we've had a little more luck in that respect lately. We also own lots of marketable securities. We've bought many of those, for example, in the mid-'70s that did very well for us, but the climate has not been as friendly toward making money out of marketable securities, and we frankly prefer we prefer the activities associated with owning and operating businesses over time. So what we hope to do, Marietta, is by the time you're ready to go to college, I would hope that Well, first of all, I'd hope I'm still around. But beyond that, I would hope that we would have, we'll be ready in about 14 years or so. I would hope that we would have another maybe 40 businesses or so that would be added, and I would hope that we would have every business that we have now. And I would hope we would not have more shares outstanding, or at least any appreciable number of more shares outstanding. And if we can get all that done, I think you'll probably be able to afford college. Charlie, do you have anything to add?
No.
And there's some things in life, Mary, that you can really count on. Okay, let's go to microphone number 2.
Good morning, Mr. Buffett and Mr. Munger. If you want to trade a share of Berkshire A for 30 shares of Berkshire B, as you had mentioned before, a personal stock split, or vice versa, is this considered a wash sale for tax purposes? Also, I'd like to ask you a question which you've heard before, but in a slightly different context. A few years ago, you said you had made a mistake by not buying shares of the major pharmaceutical companies around 1993. You cited their value to society, as well as their terrific growth, high profit margins, and great potential. You said that while you didn't know which companies would do the best, you could have made some kind of sector play because the entire sector had been decimated. These exact same words, including those about not knowing which businesses will dominate over time, can also be used to describe another industry which has recently been decimated. This industry is, of course, technology. How do you see these two investment ideas, pharmaceuticals in '93 and technology now, and what difference in the two situations makes the first a good opportunity for Berkshire and the second not one?
Well, Charlie answers all the questions about mistakes, so I will turn the second question over to him.
Personally, I think that the future of the pharmaceutical industry was easier to predict than the future of the high technology sector. In the pharmaceutical sector, almost everybody did well, and some companies did extremely well. In the other sector, where there are many permanent casualties in the high-tech sector.
Yeah, I would say that there's certainly nothing obvious to us about the fact that the tech sector as a group, or viewed in aggregate, would be a good buy or be undervalued, whereas we should have had enough sense to recognize that the pharmaceutical industry as a group was undervalued. But the pharmaceutical industry has a far better record of returns on large amounts of equity over time, and with a high percentage of the participants having those returns than the tech industry. I wouldn't regard those two as comparable at all. Your first question about exchanging and whether you have a wash sale, and I think you indicated exchanging from B into A. If you actually physically have a share of A and turn it in for 30 shares of B, that is not a taxable transaction. So there is no sale under such a circumstance. There would be no reason, unless the B was at a significant discount, to actually sell the A and buy the B. But I'm not giving tax advice on this, but I would think that I think the tax code refers to substantially identical securities when they talk about wash sales. And I would think that the IRS would be entitled to at least raise the question if you had an A share you were selling at a loss and replacing it with 30 shares of B. You'd have a better argument than if you bought a share of A back the next day. If you were establishing a loss, if you're establishing a gain, you'd have no reason. They're not worried about wash sales in that respect. You can't go from B to A by exchange, but you could go by selling 30 shares of B in the market and buying a share of A. Again, if that were being done at a loss, I think the IRS could well argue that they were substantially identical, but you could argue otherwise. Charlie?
No, I think the IRS would win.
Yeah. Charlie might even go state's evidence, if there was a thief testify. Okay, let's go to zone 3.
I'm Dan Blum from Seattle, Washington. As an insurance holding company, Berkshire Hathaway is subject to regulation by insurance or other insurance subsidiaries do business. Has that handicapped or affected your operations in any way? And do you have any trenchant or wise observations to make about governmental regulation in that context?
Yeah, we've really not been impeded in any way by the fact that Berkshire Hathaway itself is not an insurance company, but it owns various insurance companies. Of course, it owns a lot of other companies too. But being the holding company of insurance companies, which indeed are regulated by the states in which they're admitted, it really has not slowed down any acquisition. They are not, whereas with the Public Utility Holding Company Act, under that statute, the authorities are directed to be concerned with the activities of the holding company. And in the banking business, to some extent, they are. In the insurance business, there's relatively little in the way of regulation or oversight that extends up to the holding company. So it has not slowed us down in that business, but has been reported recently in the electric utility business. There's a statute from 1935, the Public Utility Holding Company Act. It's the acronym is that euphonious term PUCA. The Public Utility Holding Company Act has a lot of rules about what the parent company could do, and that act was put on the books because the holding companies of the 20s, most particularly ones formed by Sam Insull, but there were others. There were many abuses, and a good many of those abuses involved what took place at the holding company. So it was quite understandable that that act was passed in the 30s, and it achieved a pro-social purpose at the time. I don't think there's anything, frankly, pro-social about limiting Berkshire's ability to buy into other utilities. We can buy up to 5% of the stock, but we might well in the last year or two have bought an entire utility business if that statute weren't present. So we are handicapped by the utility holding company statute. We are not handicapped, in my view, by any state insurance statutes. Charlie?
Nothing to add.
Zone 4.
Good morning.
Morning.
Steve Bloomberg from Chicago. I have two questions regarding the insurance operations. With regard to the reinsurance contracts, which were written at what some consider and call good losses, you've discussed those insurance contracts in your report, indicating that it's generated $482 million of losses in the year 2000. Do we need an annual schedule disclosing the aggregate amortized charges of all current and past such deals to make our adjustments to reflect economic reality?
Well, there are two unusual type deals, and you referred to one type, what I call the pain today, gain tomorrow, or good losses type deals. And under the deals you are describing, we record a usually quite significant loss in the current year, and then we have the use of float for many years to come, and there are no subsequent charges against that. So in respect to those contracts, the important thing is that we tell you, and we should tell you, really every quarter if they're significant, and certainly yearly, any significant items that fall in that category. And as you mentioned, we had over $400 million last year. We had a significant amount the year before. We have not had a significant amount this year. I think in the first quarter there may have been a $12 million charge for one of those. If they're significant, we're going to tell you about them. It's a one-time adjustment in your mind that, in effect, you should regard as different than any other type of underwriting loss that we experience, because we willingly enter into these. We take the hit the first year, and accounting calls for that. And over the life of the contract, we expect to make money, and our experience would be that we do make money. But we'll tell you about any significant item of that sort so that you will be able to make an adjustment cost of float last year at 6%, which is high. It's not unbearable, but it's high, very high. And included in that 6% cost was about a quarter of it came from these transactions that distorted the current year figure. And therefore, our cost of float, if we hadn't willingly engaged in those transactions, would have been about 4.5%. I should mention to you that I expect that our cost of float, I said in the annual report that absent a mega catastrophe, and I might define a mega catastrophe as insured losses, we'll say, of 20 billion or more, or something on that order. Absent a mega catastrophe, we expected our cost of float to come down this year, and I said perhaps substantially. In the first quarter, our cost of float will probably run just a touch under 3% and on an annualized basis. And I think the trend is in that direction absent a mega catastrophe. I would expect the cost of float actually to come down substantially this year. But if we were to take on some of these pain today, gain tomorrow transactions, and we don't have any in the works at the moment, but if we were to take those on, then it would be reflected in our cost of float, and we would lay out the impact of that sort of transaction. Charlie?
Yeah, I think almost all good businesses have occasions where they're making today look a little worse than today would otherwise be to help tomorrow. So I regard these transactions as very much the friends of the shareholders.
We have a second type of transaction, just to complete, which we also described in the report, which also creates a large amount of float, but where accounting rules spread the cost of that transaction over the life of the float. And those do not distort the current year figures, but they do create an annual charge that exists throughout the life of float. And that charge with us is running something over $300 million a year. But there again, it's a transaction that we willingly and enthusiastically engaged in. And that has this annual cost attached to it. So when you see our cost of float at 3% annualized in the first quarter, it includes probably a $80 million charge or so relative to those retroactive insurance contracts, which were the second kind described in the report. I recognize this accounting is, and even the transactions are somewhat Greek to some of you, but they are important in respect to Berkshire. So we do want to lay them out in the annual report for those who want to do their own calculations of intrinsic value. Zone 5.
Good morning, gentlemen. My name is Jay Parker. I'm from Washington State. And this question regards mistakes. So that being the case, it should probably be directed to Mr. Munger. Mr. Munger, I know you're fond of evoking humility to promote rational thought. So my question is, what's the most recent business mistake that you've made, Mr. Munger, and why did it occur?
I'm going to take notes on this one.
The mistakes that have been most extreme in Berkshire's history are mistakes of omission. They don't show up in our figures. They show up in opportunity costs. In other words, we have opportunities. We almost do it. In retrospect, we can tell that we were very much mistaken not to do it. In terms of the shareholders, those are the ones in our history that have really cost the most. And very few managements do much thinking or talking about opportunity costs. But, Warren, we have blown
billions and billions and billions. I might as well say it.
Right. And we keep doing it.
Some might say we're getting better at it.
I don't like mentioning the specific companies because we may in due course want to do so at our price. But practically everywhere in life and in corporate life too, what really costs in comparison with what easily might have been are the blown opportunities. I mean, it's an awesome amount of money. When I was somewhat younger, I was offered 300 shares of Belridge Oil. An idiot could have told there was no possibility of losing money and a large possibility of making money. I bought it. The guy called me back 3 days later and offered me 1,500 more shares. But this time I had to sell something to buy the damn Belridge Oil. That mistake, if you traced it through, has cost me $200 million. And it was all because I had to go to a slight inconvenience and sell something. Berkshire does that kind of thing too. We never get over it.
Yeah. I might add that when we speak of errors of omission, of which we've had plenty, and some very big ones, we don't mean not buying some stock where a friend runs it or we know the name and it went from 1 to 100. That doesn't mean anything. We only regard errors as being things that are within our circle of competence. So if somebody knows how to make money in cocoa beans, or they know how to make money in a software company or anything, and we miss that, that is not an error as far as we're concerned. What's an error is when it's something we understand and we stand there and stare at it and we don't do anything. Or worse yet, what really gets me is when we do something very small with it. We do an eyedropper's worth of it when we could do it very big. Charlie refers to that elegantly when I do that sort of thing as when I'm sucking my thumb. And they're really, I mean, we have been thumb suckers at times with businesses that we understood well. And it may have been because we started buying and the price moved up a little, and we waited around hoping we would get more at the price we originally started. There can be a lot of things, but those are huge mistakes. Conventional accounting, of course, does not pick those up at all, but they're in our scorebook. Zone 6, please.
My name is Joseph LaPrey. I am from Minneapolis, Minnesota. In recent years, tobacco companies have been compelled to pay large damages for marketing their unhealthy but discretionary products. My question has two parts. First, does the potential for similar damage liabilities reduce the intrinsic value of Coca-Cola, See's Candies, Dairy Queen, or any other business which sells discretionary products of questionable healthfulness? Not that I don't like these products. And second, are either of you concerned that a possible erosion in the principle of caveat emptor is undermining the legal basis of contracts in general? Thank you for taking my question.
Well, the products you described I've been living on for 70 years, so they'll probably haul me in as a witness if that they don't do much damage. No, I think if you're opposed to sugar, and I think the average human being eats something like 550 pounds dry weight of food a year, and I think 125 pounds or thereabouts. I'd have to look at it. It consists of sugar in one form or another. I mean, it's in practically every product that you have, and it happens to be in Coca-Cola, it happens to be in See's Candy, but it's in practically everything. It's over 20% of what Americans are consuming one way or another. And the average lifespan of Americans keeps going up. So I would not be worried at all about product liability in connection with those companies. But product liability generally is an area that is a fertile field for the plaintiff's bar, and we are conscious in buying into businesses, and we have passed up some businesses because we were worried about the product liability potential. Unless there is some legislative solution, I think you will see more and more of the GDP going into liability awards, and whether there will be any change by legislation, I don't know. But it's a big field, and the lottery ticket aspect of it is so attractive, because if an attorney can gamble a modest amount of time or even a reasonable amount of time and have a potential payoff of 10 or 20 or maybe in some cases hundreds of millions of dollars, that's a decent lottery ticket. Who knows what 12 people are going to be on the jury? As one of my friends who's a lawyer said, he said Lincoln said you can fool all of the people some of the time and all of the some of the people all the time and all of the people some of the time, but not all of them all the time. He says, I'm just looking for 12 that you can fool all of the time, all you have to do is get an award. And the odds are fairly favorable in a nation where lots of zeros have sort of lost meaning to people. So it's a very real concern in any business we get into in terms of trying to evaluate product liability. Charlie?
What's particularly pernicious is the increasing political power of the plaintiff's contingency fee bar. If you're on a state Supreme Court, in most places you're on for life. If you you're on for life if you want to stay for life. And the one thing that could get you off the court would be to really irritate some important group. And I think that greatly helps a lot of abusive conduct in the courts. I think the judges of the country haven't been nearly as tough as they should be on junk science, junk economic testimony, trashy lawyers. And I don't see many signs that it's getting better. In Texas, they actually improved the Supreme Court of Texas, which really needed it. So there are occasional glimmers of light.
We make our decisions in insurance and in buying businesses with a very pessimistic attitude toward the chances of that particular ill that Charlie described being even moderated. I mean, we think we would project out that the trend would accelerate, but that's just our natural way of building in a margin of safety in decisions. Don't worry about eating the See's candy or the Dairy Queen or the Coke. If you read the papers long enough, I use a lot of salt, and I was always being warned about that. And then, a few years ago they started saying, you can't get enough salt and all that. I don't know what the answer is, but I feel terrific. Zone 7.
Good morning. I'm Murray Cass from Markham, Ontario. The financial community relies heavily on the P/E ratio when evaluating prospective investments. When you buy a company, you must certainly consider not just the future stream of earnings, but also the company's financial condition, among other things. By financial condition, I'm speaking mainly of cash and debt. But the PE doesn't take into consideration either cash or debt. Occasionally, you see a company with consistently positive free cash flow trading just over cash value, effectively giving away the future earnings. In cases like this, the PE looks terribly overstated unless adjusted for cash and debt. I've always preferred companies with oodles of cash to those burdened with lots of debt. And then I read Phil Fisher's book, Conservative Investors Sleep Well. Well, I haven't slept well since. He really confused me when he commented that hoarding cash was evil. He wrote that instead companies should either put the cash to good use or distribute it to shareholders. Can I get your thoughts on this?
Well, there are times when we're awash in cash, and there have been plenty of times when we didn't have enough cash. Charlie and I remember in the late 60s, when bank credit was very difficult, we were looking for money over in the Middle East. Do you remember that, Charlie?
Yes, I do.
Yeah, and
they wanted us to repay it in dinars.
Yeah, and the guy that wanted us to repay him in dinars or dinars or whatever the hell they call them, was also the guy that determined the value of those things. So we were not terribly excited about on payday and having him decide the exchange rate on that date. But we obviously are looking every day for ways to deploy cash. And we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it just to employ it. And in recent years, we've tended to be cash heavy, but not because we wanted cash per se. In the mid-'70s, we were scraping around for every dime we could find to buy things. We don't like lots of leverage, and we never will. We'll never borrow lots of money at Berkshire. It's just not our style. But you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it. Charlie?
I can't add anything to that.
Zone 8.
Good morning. My name is Mark Dixon from Sarasota, Florida, and I'd like to thank you for providing this forum for all of us. It's wonderful. In past years, you've been very specific about some of the numbers related to Coca-Cola, Wells Fargo, Rockwood, specifically like with Coca-Cola, cost of aluminum and sugar and all that goes into the bottom line of Coca-Cola. Can you provide some of the specific numbers that go into some of your more recent purchases over the last couple of years?
Well, they have such different characteristics. That's very difficult. I mean, we have service businesses such as flight safety and executive jet as a service business. And, in many of those companies, the big cost is personnel. I mean, we need people at a flight safety. We've got a lot of money invested in simulators. We'll put over $200 million into simulators this year, just as we did last year. So we have a big capital cost in that business. And then we have a big people cost, because we are training pilots. And that's very person-on-person intensive. NetJets, part of executive jet, very people intensive. I mean, we are absolutely no better than the people that interact with our clientele. You get into something like the carpet business, and maybe only 15% of your revenues will be accounted for by employment costs, and you're a very heavy raw material buyer. I mean, you're buying lots of fiber, and so it varies enormously by the kind of business here. I mean, when we're in the insurance business, we're in the business of paying future claims, and that's our big cost, and that obviously involves estimates, because sometimes we're going to pay the claim 5, 10, or 20 years later. We're not going to know about it sometimes till 20 years later. So it's very hard to generalize among the businesses. If you're in the retail business, which we are in the furniture and jewelry in a significant way, purchased goods are obviously very important. We don't manufacture our own goods to any extent in those businesses. And then the second cost, of course, is labor in a business like that. But we don't have any notions as to what we want to buy based on how their costs are segmented. What we really are looking for is an enduring competitive advantage. I mean, that's what's going through our mind all the time. And then we want, obviously, top-notch people running the place, because we're not going to run them ourselves. So those are the two factors we look at. We want to understand the cost structure, but Charlie and I can understand the cost structure of many companies. There's many we can't, but we can understand them of a good many companies. And we don't really care whether we're buying into a people-intensive business, a raw material-intensive business, a rent-intensive business. We do want to understand it and understand why it's got an edge against its competitors. Charlie?
Yeah, basically, to some extent, we're like the hedgehog that knows one big thing. If you generate float at 3% per annum and buy businesses that earn 13% per annum with the proceeds of the float, we have actually figured out that that's a pretty good position to be in.
It took us a long time. Incidentally, I would hope that we would and actually expect that absent a mega catastrophe, that 3% figure will come down over the next, in the near future. But a mega catastrophe could change all of that. I mean, if you had a $50 billion insured catastrophe, Tokyo earthquake, California earthquake, Florida hurricane, I mean, those we're in the business of taking those risks. We're the largest insurer, as you may know, of the California Earthquake Authority. I have a sister here who is from Carmel, and she used to call me when the dogs and cats start running in circles. And so we're exposed to some things that could change, but absent a mega catastrophe, experience is going in the right way at really at all of our insurance companies. And I would expect that to continue for a while, and then at some point I'd expect it to reverse itself. Isn't that helpful? Area 1, please.
Good morning. I'm Martin Wiegand from Chevy Chase, Maryland.
Good to have you here, Martin.
Thank you. Thank you for the wonderful shareholder weekend, and thank you for the leadership and education you give your shareholders and the general public. My question. Large airlines are in the news negotiating labor contracts. They claim they can't pass along rising labor costs to their customers. In the annual report, you say Executive Jet is growing fast and doing great. Executive Jet seems to be able to pass along its rising labor costs to its customers. Is this because Executive Jet has a rational compensation plan that keeps employee salaries in line with billable services? If not, why does Executive Jet do well while the airlines experience troubles?
Well, the big problem with the airlines is not so much what their aggregate payments will be. The real problem is when you're in the airline business and your wage rates are out of line with your competitors. When you get right down to it, the figure to look at with an airline, among a lot of other things, but you start with the cost per available seat mile, and then you work that through based on the capacity utilization to get to the revenue per, or the cost per occupied seat mile. And you could have labor costs or any other cost. You certainly have fuel costs up dramatically for the airlines from a couple of years ago. As long as you're more efficient than your competitor and your costs are not higher than your competitor, people will continue to fly. It's when you get your costs out of line with your competitor, which was the situation that, or Charlie and I were directors of US Air a few years back, and our costs per seat mile were far higher than competitors, and that was fine where we didn't have competitors on many of the short routes in the east. But as a Southwest Airlines would move into our territory, and they had costs, we'll say, and this is from memory, but they might have had costs of below 8 cents a seat mile, and our cost might have been 12 cents a seat mile. You know, that is, you're going to get killed eventually. They may not get to this route this year, but they'll get there next year or the year after. So if you're running a big airline, a Delta or United or whatever, if your costs are on parity or less labor costs than your other major competitors, that is much more important to you than the absolute level. And the NetJets service is not really designed to be competitive with the United Airlines or an American or something of that sort. It has a different group of competitors, and I think we have a absolutely terrific pilot force there, and we want them to be happy. But there's a lot of other ways. I mean, you want to pay them fairly, but with our pilots, for example, it's extremely important to them in many cases to be able to live where they want to and to work the kind of shifts that we can offer. So we attract them in many other ways than bidding against United Airlines or American Airlines. Big thing, and you can't take labor costs that are materially higher than your competitor in a business that has commodity-like characteristics such as airline seats. You just can't do it over time, and you can get away with it for a while, but sooner or later the nature of a capitalist society is that the guy with the lower costs comes in and kills you. Charlie?
The airline unions are really tough, and it's interesting to see a group of people that are paid as well as airline pilots with such a brutally tough union structure. And that really makes it hard in a commodity style business, and no individual airline can take a long shutdown without having considerable effects on habit patterns and future prospects. It's just a very tough business by its nature. Passenger rail travel, even in a previous era, was a pretty tough way to make a buck. And nothing is all that different with the airline travel. We hope that our services are preferred by customers more than one airline seat is preferred compared to another.
Yeah, fractional ownership is not a commodity business. I mean, the people care enormously about service and the assurance of safety. And I don't think that, I don't think if you were buying a parachute, you'd want to take necessarily take the low bid. Now, with the big commercial airlines with millions and millions of passengers, people, I think, probably correctly assume that there's quite a similarity in both service and safety. But if you're in a business that cannot take a long strike, you're basically playing a game of chicken, with your labor unions, because they're going to lose their jobs too if you close down. So you're playing a game of chicken periodically, and it has a lot. There's a lot of games. There's a lot of game theory that gets involved. To some extent, the weaker you are, the better your bargaining position is, because if you're extremely weak, even a very short strike will put you out of business, and the people who are on the other side of the negotiating table understand that. Whereas if you have a fair amount of strength, they can push you harder. But it is no fun being in a business where you cannot take a strike. We faced that one time back in the early 80s when we were in kind of a death struggle in Buffalo with the Courier Express. And when I bought the Buffalo News, actually Charlie did, he was stranded there during a snowstorm and he got bored. So he called me and said, "What should I do?" I said, "Well, you might as well buy the paper." And so we were in this struggle, but when we bought the Buffalo News, we had two questions of the management, and one of them I can't tell you. But the second one was we wanted to meet with the key union leaders, and we wanted to tell them, look, if you ever strike us for any significant length of time, we're out of business. You can make our investment valueless. So we really want to look you in the eye and see what kind of people you are before we write this check. And we felt quite good about the people, and they were good people. And we had one situation in 1981 or thereabouts where a very, very small union, I think less than 2% of our employees, struck over an issue that the other 10 or 11 unions really didn't agree with them that much on. But they struck, and the other unions observed the picket line, which you would expect them to do in a strongly pro-union town such as Buffalo. And I think, as I remember, they struck on a Monday, and I remember leaders of some of the other unions actually with tears in their eyes over this, because they could see it was going to put us out of business. And frankly, I just took the position then I said, look, if you come back in a day, I know we're competitive. If you come back in a year, I know we will not be competitive. And if you're smart enough to figure out where exactly the point is that you can push us to and still come back and we have a business and you have jobs, I said, you're smarter than I am. So, go home and figure it out. And they came back in on Thursday, and we became very competitive again. But they could have, it was out of my hands. I couldn't make them work. And if they decided they were going to stay out long enough, we were not going to have a newspaper. And that's the kind of situation occasionally you find yourself in. And I would say the airline industry is a good example of people where people find themselves in that position periodically. Charlie, have any more?
Well, the shareholders may be interested to know, vis-a-vis competitive advantages in our NetJets program, that the day that other charter plane crashed in Aspen, NetJets refused to fly into Aspen at all. People remember that kind of thing.
Yeah. Zone 2.
Good morning, gentlemen. David Winters from Mountain Lakes, New Jersey. Thank you for hosting Woodstock for Capitalists. Berkshire seems to have an enormous long-term advantage in spite of its large size and high equity prices. The structure of the company's activities, non-callable capital, substantial free cash flow, and improving insurance fundamentals permit Berkshire to capitalize on potential asset price declines and dislocations in financial markets, while most investors would not either have the money or the cool minds to buy. Am I on the right track here?
Well, I think in certain ways you are. I mean, we do have disadvantages too. But we have some significant advantages in buying businesses over time. We would be the preferred purchaser, I think, for a reasonable number of private companies and public companies as well. And our check's clear. So we will always have the money. People know that when we make a deal, it will get done, and it will get done as fast as anybody can do it. It won't be subject to any kind of second thoughts or financing difficulties. And we bought, as you know, we bought Johns Manville because the other group had financing difficulties. People know they will get to run their businesses as they've run them before if they care about that, and a lot of people do. Others don't. We have an ownership structure that is probably more stable than any company our size or anywhere near our size in the country, and that's attractive to people. So, and we are under no pressure to do anything dumb. If we do things dumb, it's because we do things dumb, and it's not because anybody's making us do it. So those are significant advantages. And the biggest disadvantage we have is size. I mean, it is harder to double the market value of a $100 billion company than a $1 billion company using what we have in our arsenal. And that isn't, I hope it isn't going to go away. I mean, I hope we don't become a $1 billion company and enjoy all the benefits of those. And I hope, in fact, we have the agony of becoming, a much larger company. So you are on the right track. Whether we can deliver or not is another question. But we go into combat every day armed with those advantages. Charlie?
Yeah, this is not a hog heaven period for Berkshire. The investment game is getting more and more competitive, and I see no sign that is going to change.
But people will do stupid things in the future. There's no question. I mean, I will guarantee you sometime in the next 20 years that people will do some exceptionally stupid things in equity markets, and then the question is, are we in a position to do something about that when that happens? But we continue to prefer to buy businesses, though. That's what we really enjoy. When Charlie mentioned hog heaven, I thought we ought to open the peanut brittle here, which I recommend heartily. Zone 3.
Good morning. Mo Spence from Waterloo, Nebraska. You've often stated that value and growth are opposite sides of the same coin. Would you care to elaborate on that? And do you prefer a growth company that is selling cheap or a value company with moderate or better growth prospects?
Well, actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to growth usually is a positive for value, but only when it means that by adding capital now you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year. But whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful, I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case, again, is the airline business. The airline business has been a growth business ever since, that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public. But growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. Charlie?
Well, I think it's fair to say that Berkshire, with a very limited headquarters staff, and that staff pretty old, we are especially partial to laying out large sums of money under circumstances where we won't have to be smart again. In other words, if we buy good businesses run by good people at reasonable prices, there's a good chance that you people will prosper us for many decades without more intelligence at headquarters. And you can say, in a sense, that's growth stock investing.
Yeah, if you'd asked Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business, a growth stock or value stock, who knows what they would have said. But, the real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.